When we talk about the U.S., we always have to, kick off with where is the Fed? What are some of the things that are being done? Because it's going to drive the consumer based on credit card rates, mortgage rates, and obviously on a global level in terms of where is the international 10-year pricing. But at the same time, what is that going to do to the U.S. economy? How is that going to either help or hurt where things are? And one of the things that is rare to see and it's important to look at where we are in terms of that red, which is obviously a recession. You can see that during those periods, there is a decrease in rates. And normally the decrease in rates is to help stimulate, make things a bit easier. But it isn't it is unusual, but not unprecedented. And it's one of the things I want to call to attention is that one in 1974 into 1975, where you can see there were multiple rate hikes that happened and this big spike before there was a broader easing. But then that quick easing then led to a lot of noise that happened into the 80s. And it's important to appreciate what does that mean? And when you look at how we've gotten used to cheaper and cheaper debt, when you just look at where the trend has been, at this point we have inflation that continues to run rampant. It is slowing for different reasons, whether that be supply chain or some of this slowdown. But when you look at the underlying cost, to the consumer, things haven't gotten any better. We haven't seen much in terms of, I haven't gone to the food and been happy or surprised to see, my prices come down. We haven't, bought things for presents and birthdays and been like, oh, that was $5 cheaper, $5 more expensive 3 months ago. We haven't seen that, and it's because there's still a lot of cost that it resides in the system, which is when you start looking at the slowdown, the Fed, and this is, I think, a key piece, you need to be able to tighten in order to ease again. Again, this comes back to law of diminishing returns and what I tried to explain with a bow and arrow. So if you have your bow and you never tighten the string, well, that arrow goes less and it doesn't go as far, and then until eventually it goes nowhere. And it actually comes down and, it lands directly on your foot, stabbing you in the foot. So when you look at the tightening is just as, if not more important than the easing, because as long as you tighten, you open up opportunity to ease when things start to get tough again. But when you look at the trend, there's always been a hesitancy to get back to that point because when you tighten, you do create some slowdowns, you reduce some labor, but that's okay. It's okay to have a higher hurdle rate. It makes people smarter with their money. It makes, and not, I'd like to say that they would always be smarter, but it makes companies evaluate things a bit differently. It makes their investors say, okay, do more due diligence than I just have a low hurdle rate. So as long as I can get paid out over the next 5 years before this goes bankrupt, I don't care. There's a lot of things that can be adjusted with that, but there is a lot of pressure, and because of inflation, because of how long they waited and the sheer amount that was put into the system since 2009, it's going to be very difficult, even in a recessionary backdrop, to see cuts without seeing a more aggressive increase. Now, I thought this was a good chart kind of summarizing why or what would cause the variables for the NBER to declare a recession. And it comes down to some of the things that we've been talking about. When you look at real consumer spending, industrial production, both of those things, with real consumer spending kind of waffling with slightly negative, slightly positive, but industrial production remains above in an expansionary place. We do think it goes into contraction, but we don't think it happens yet. And that is some of the big pieces, is just in terms of where is that consumer spending, and then where is the industrial production. And that, again, even though it was negative, and if you remember, in Q4, we discounted how strong that GDP print was because it was all driven by inventories. But then when you look at the slowdown in Q2, a lot of that was driven by inventory. So you can't discount, or at least from our perspective, you can't discount Q4 and then not do the same and give a little bit of a cushion for Q2 given the inventory moves. And that's why, and we said it in Q4, inventories are lumpy and it's going to cause swings both up and down, and you need to account for that, which is what we tried to do to again try to be consistent in terms of where things are going. But one of the things, and again, this is on the back of the recession view, the market continues to expect the Fed to overreact to the downside. And one of the things that we've been highlighting is they don't have a choice but to stay elevated and stay higher because they've waited too long. There's too much inflation in the system. They have no choice but to, again, try to tighten and get things back in line. And the MOVE index is, again, continuing to remain elevated. It's been waffling between 119, 125. And when you look, those are levels that are consistent with where we were in 2008, 2009. You're looking at, again, where it's not just this big spike and a drop. It's just this consistent volatility that remains at this level, and that creates a problem, which is why we've seen bonds slow down, new bond offerings. We've seen costs go up because they're trying to account for the volatility. Or should rates go up because of inflation, or should they go down because of a recession? There's all of this back and forth in terms of where these moves are going. So when we name the segment in terms of consumer sentiment, it's important to understand where the Fed is going, where rates are going, because that's going to, again, trickle down to how is the consumer going to react. Are jobs going to be plentiful still? Are raising rates? Are we going to see labor slow down, which means wages will slow down, and the disconnect between wages and inflation is going to remain, and that's going to accelerate the move in terms of just the pain the consumer feels and the lack of spending that they're going to do. And I think this is a good leading indicator when you look at the Dallas Fed trim mean PCE had the largest 1 month annualized jump of 6.9% in June, which is the highest since July of 1982. So again, there's still that pressure in terms of that mean component. And I think that's the most important piece, because everyone wants to say, well, gasoline's going down, therefore inflation is going down. It's like, well, there's a lot of things that come into making up price, making up cost, making up a lot of how these prices are going to work out, which is why we think that there's going to be more pressure ahead that's being indicated by just where this chart is and how it continues to be above core PCE. It continues to, again, show the trend that we're seeing. Now, even though we see a lot of this pressure, the net purchase among retail investors of basket tech stocks is moving back to the highs. And when you look at it, it's actually the highest it's been for all of 2022, and it's actually back to the highs from 2020. So you're seeing a huge move in the top net buys among individual investors in 2022. S&P 500 and the Qs. So again, there is still a buy the dip mentality, which is why you're looking at all this data and you're like, well, the data seems concerning, but yet the stock market is just doing its thing. And again, there's the economy and there's the market, and the two shall never meet at this point. But this is again creating those dip buyers. And as we said previously, it's hard to change the mantra, because if you go back to 2009 and if you bought every dip, you crushed it. There was not a dip that didn't deserve to be bought and work out beautifully. And that's where, until you get real pain, where I bought the dip and I'm underwater, I bought the dip again, I'm underwater, I bought the dip again, I'm getting liquidated. Until you get that, that's where, and we've had some of it, we've had some shifts, but you're still not seeing that real pain point. And I thought this was an interesting, and again, I don't talk about crypto. I will never, that is not my world. I know it's kitschy, and I know people like to talk about it. That's not my strength, but I'm talking about in the sense of it is a holding of some of these retail investors, and that's why it's important to look at how is this shifting. And when you look at have you sold off any of your cryptocurrency investments in the last few weeks? by annual income, those on the lower scale have started to liquidate because they're seeing the news, they're seeing the concerns, they're not as liquid. They may have done it on margin, thinking that it was only going to go up, and that's where you're going to start to get some of this pivot. And that's an important component when you look at the shift in terms of sentiment. Is it come to a point where, you know what, Apple stock is a better deal right now? There's bankruptcies, there's these unknowns. I don't really know what's going on here. I know people have either lost money, I've lost money, or I want to make sure that I can get this money back, because now, for anyone that follows crypto, there are litigations happening. There's money that's locked in that you may not be able to access for months, if not years at a time. But I can buy Apple, I can buy the Qs, I can buy SPY, and I can always get it back within seconds. So again, that also can create the pivot. But I think it's important to look at how is that sentiment shifting. Now, when you look at the 10-year through to 3-month government bond spread, it is currently negative, and it's again just showing that the recession is starting to get priced in. When the 10-year to 3-month portion of the yield curve is about to invert, some economists prefer this metric as a leading indicator of economic activity, and you can see just where it is. Market pricing for the Fed funds change between July meeting and the end of 2022 is pricing in a little bit less aggressive rate hikes. But then when you look at the commentary out there, they're still kind of drumming up that 75 basis point increase, which could become a much bigger problem when you're looking at market expectations, which is why I think they're trying to temper kind of where the market is, because if the market is expecting 50 basis points and they come in with 75, there's a concern that there would be an overreaction to the downside, and they like to protect the market versus what they should be protecting, which is the economy, and just in terms of where they are. And you may say, but cutting rates is protecting the economy. And my pushback would be their mismanagement of this for so long is only going to make what is coming that much worse. So they need to try to manage things for the longer term, because the short term is going to be noisy, it's going to be painful, but you need that pain for the longer term growth that we think is still possible. Near-term forward spreads, continues to collapse. There's still, again, a lot of that concern in terms of not only the recession, but also how is the Fed going to react, as that recession becomes more prevalent as we move further along. U.S. breakdown of July-September Treasury debt issuance. You can see that there is going to be a bigger increase as we go through September, which is why as more volume comes on, the Fed is not only are they not a net buyer, they're a net seller as the Treasury comes in, which is going to keep, again, rates trending, or yield, I should say, trending to the higher end, as this will put more volume and pressure. So as all of this is happening, where is the economic sentiment? Where are things shifting? And here you can see when you look at personal finances, they're trending a bit lower. New jobs, again, starting to move down. U.S. economy, the views there are remaining under pressure. But again, the trend is still down, but it's not a huge drop off. And we have to look at, what is going to change that? Well, challenger job cut announcements have increased. I'm sure you've seen the headlines about Walmart and others, where you're starting to see now job cuts starting to become more prevalent, which is going to show up in the new jobs, in a lot of these key data points, which will take time to really come through and really start to unwind. So it's the second consecutive month. Job cuts at 36.3% versus 58.8% in prior month. Auto sector has led this year with over 25,000 job cuts, 9,500 of which occurred in July. The tech sector is in second place with year-to-date total of 9.3%, and that's something that we do think continues to become a problem. And sorry, I keep forgetting to mute the phone. So when you start looking at the challenger job cuts in general, that again is that leading indicator for some of the pain that we're going to see, and how you're going to jobs plentiful is going to adjust a bit. But there's still such a disconnect, which we talked about last week, and we're going to talk about again here in terms of that participation rate, which is keeping some of the wages elevated and where some of this sits right now. The difficult times are increasing. 4 in 10 adults are having difficulty covering their usual household expenses as wages fail to keep up with surging prices. So when you look at the shift between 2021 and 2022, this, again, you're starting to have that difficulty come up. And it starts with, well, it's difficult, but I still have access to credit. It's hard, but I can still use my credit cards. Now, credit card rates are going up, and we're at that key pivot point where we think we start to see that bigger drop in retail sales, and you start to see that acceleration as the pain point comes up, especially when you start looking at consumer debt by income percentile for Q1, which we know Q1, it started to go up, but Q2 is where it accelerated. Q2 is when you got this huge increase and this big problem in terms of consumer credit. So this is just take into account that this is a reduced number of where we currently sit, and it is still significantly higher on the consumer debt side. Same can be said for U.S. household excess savings. A lot of that has been drawn down between Q1 and Q2. So when you look at the amount of money saved between Q1 of 2020 and Q1 of 2022, this is still showing that there is that excess savings. And our whole thing is that it's not as aggressive and not as high as this is leading to believe, given the fact that you've had an increase in credit cards. Because if you had the excess savings, why would you take an 18% APR on a credit card where you could try to pay down using what you have in savings? So again, there's some of that disconnect, but this has supported spending. And again, the view is, when does that stop? And our view is it has. July is really that pivot point where it has stopped. And that's why going forward from this point on, you get a much bigger drop where everybody saw it coming. People talked about it. When they answered their surveys, they talked about how this is getting worse, it's slowing down. But now it's actually rubber meets the road, and I need to stop spending this way. And that's where we're seeing that get worse. And this is just showing the consumer sentiment by income, which has continued to move down, continued to move in the negative light. But it's important to look at when it started, which was 2022. And everything was kind of flat in 21. And it's because it's like, well, I have savings, I still have, I have spare room on the credit card. That's why the pivot accelerating. And if you look at when it accelerated, it was that Q2 period and has only gone all the way down since, which is again, leading back to our comment that going forward, we have the much bigger problem. Wealthier consumers' confidence deteriorating at a faster rate than that of those on the lower end of the income spectrum. So the spread between over 125,000 and 15 to 24,000 income confidence has fallen to the lowest since the summer of 2020. And remember, the higher earner is the one that has the most discretionary income, the most ability to go out and spend. And as that comes down, as that tightens, that's when you get the real hit in terms of that volume and that move through, which again, leading to how this is the pivot into slower sales. Amid high inflation, households have trouble paying for usual expenses. And if you look at, again, 2021 versus 2022, the pivot has been there. The pivot is now much bigger, where we're going from less than 30% to more than 40%. And it is across the board in a lot of these specific areas, which again leads us to believe why there's going to be a situation now where it's not just feeling bad sentiment, but actually in the data, physically walking out of the store with less packages. You could say, well, you could, going into the food store, somebody may give you a questionnaire. Well, how are you feeling? It's like, oh, well, my job, it's uncertain, things, income is slowed down. I'm walking into the store right here. Prices are going to be high, but they're still going to walk out of the store holding the same amount of goods, the same amount of bags. The question is, when do they walk out of that store with less? And our point here is it's happening now, and it's going to only accelerate going forward. So when we look at the big gap, this is another, I think, big increase in terms of, well, how are the banks doing in all of this, and how is the person feeling about it? So when you look at banks are doling out little to savers as they earn more from lending. So the deposit expense, when you look at where it is in the total interest income, I always find it amazing when you look at the difference between the two. And then savings accounts are doing little to soothe the pain of inflation. And it's interesting because when you look at the average savings account rate, and we've talked about this before, it usually matched inflation, going back to the 70s and 80s. But now, what are you getting? 0.07%, while inflation is sitting at over 8%. And again, you're not seeing a lot of that pass through, but you're also not seeing the debt side. So yes, debt has gone up, rates have gone up. So if it's at 3%, but if you go back to the 70s and 80s, you're looking at something that was much closer to bonds sitting at 18%. So inflation being, just looking at this, sitting at 6%, bonds at 18%, they have the ability to give you that money. And again, this is where there's some of that disconnect. But I do think the banks need to give some of that support because you're investing this money with our savings. So it's our savings that are going in and allowing you to go out and make these purchases, make these loans. And there has to be some of that gets passed back through. Standard checking, personal savings, when you're looking at just the underlying rates, just gives you an idea where standard checking is 0.08 with personal savings at 0.13%. So to give you an idea of just what that interest looks like. So then when you look at millions of households have zero savings, and this again comes full circle to, yes, we know what was in Q1, but where is it now? And more than half of consumers surveyed by Lending Club said that they have less than $5,000 saved. 29% have more than $15,000 saved. So when you look at just where the level is, you're looking at there is a significant amount of people that do not have savings. So again, it's important to understand timing in terms of Q1 versus Q2, because Q2 is really where you had a huge shift. And so some of that older data will be a bit misleading. So then when we start looking at the real final sales to private domestic purchasers, you can see that we're just about going negative, while real gross domestic products is moving down as gross domestic product. Again, that disconnect continues, and that pivot now on final sales is where we see that continuing to go down in Q3 and really feeding into that recession that we've been discussing. Especially when you start looking at that, again, that real personal consumption expenditures starting to pivot. That pivot, you kind of go sideways and now you're starting to roll over. And as U.S. real personal income ex transfer receipts remains negative, again, that's just going to get worse, especially as job cuts increase, the availability of jobs decreases, means you can be less competitive on what you demand for a wage. And that's, again, going to make the wage side, the real wages, personal income worse, even as prices remain fairly sticky. And that's when you start looking at the federal minimum wage. You get in 2022, obviously, just in terms of where it is against inflation, you get an idea of the underlying pain when you convert it back to, essentially moving it into the real wages. So after the longest period in history without an increase, the federal minimum wage today is worth 27% less than 13 years ago and 40% less than in 1968. Just to give you an idea of just how the impact of inflation is a huge tax, and it is a tax that hits the poor and the middle, up to the middle class the hardest, because typically if you're in the upper class, even upper middle class, you have the ability to invest in ways to try to offset. You typically own real estate, hard assets, which do well in inflationary periods, again, creating that wealth gap that we've talked about. Net percent of domestic respondents tightening standards for commercial real estate loans continues to go up across the board, just because, again, the risk is there, the concerns are there, and the movement on inflation. And here's some of the key pieces on the change from levels in non-farm, total non-farm payrolls. And when you look at the accommodations, you get an idea of where that shift is. So because of that shift, even though there are some people that are doing more from home, the daily visits to various locations versus pre-pandemic, public transportation, workplace, retail, and recreation still remain below pre-pandemic levels, which is something that we've been talking about on the EIA show and continuing to remain the case. So that's what we have for you on the consumer side. But at the same time, when you look at retail and recreation, not going back to pre-pandemic, again, some of those slowdowns, and we see that becoming a much bigger problem. In the next segment, we're going to go deeper into some of the leading indicators and how there's some good and some bad. And we want to shake out in terms of which one matters the most right now and which one may have just had a bit of a reprieve and will get a bit worse.